Hey everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about everything you need to know regarding required minimum distributions. So, as many of you know, something called the Secure Act 2.0 just passed in December of 2022 and began to take effect in January of 2023. So, this video is going to be updated with all of those new rules. And specifically, I'm going to be talking about 5 key areas as they relate to these required minimum distributions. Number one, we're going to be talking about which types of accounts you have to take required minimum distributions from. And there was one small rule change with the Secure Act 2.0 that did impact a little bit there of what types of accounts are going to be affected by RMDs or required minimum distributions. Number two, we're going to be talking about when you have to start taking these required minimum distributions. So again, this was one key area that was affected by the Secure Act 2.0, so we're going to be getting into that. Then we're going to be talking about how much. That's a big question we get asked all the time. How much do you have to start taking out once your RMDs begin? And then number four, we're going to be talking about what you can do with your required minimum distribution. So once you have to start taking that money out, what are some of your options? And I've got my favorite. We'll talk about that here in just a little bit. And then number five, we're going to talk about what if you miss a required minimum distribution. Made a couple little small rule changes there with the Secure Act 2.0 regarding a missed RMD payment as well. So real quick though, before we get into the content of today's video, if you want to learn more about what we do at Money Evolution, or you're watching this and say, hey, we might want some help on some of this stuff, we have our comprehensive financial plan called Wealth Vision. You can learn more about that by clicking on one of the links below or going to wealthvisionplan.com. That'll take you to a page. It's got a lot of great information about our comprehensive financial plan. And if you're interested in what you see on that page, there's a spot for you to sign up for a free introductory call with me. So check that out. And also, too, we have our retirement planning course called the Retirement Time Machine. It's a little bit more of a DIY sort of a financial planning process, but lots of really great information there. I think we have over 13 hours of video instruction and the ability to create your own financial plan using some software that we use for some of our more advanced comprehensive financial plans. So check out the links below in the description there, and we'll jump right into the video. Okay, so let's start off by talking about what types of accounts are going to be impacted by required minimum distributions. But real quick, before we get into that, it's important to know what is a required minimum distribution. Well, a required minimum distribution is basically the IRS's way to say, hey, you've gone long enough without paying us any tax revenue on this money or on this account. So when you get to a certain age, they're going to force you to start taking minimum distributions out of that account each year and effectively paying income taxes on that. So typically that's going to be any of your traditional types of retirement accounts, anything that's growing tax deferred. Things like your traditional IRA account, your 401k, 403b, simple and SEP IRA accounts, anything that you were basically putting off paying taxes and growing that money tax deferred. And again, when you get to a certain age, you have to start taking these minimum distributions. A couple of accounts that are not required to take required minimum distributions. One of those is Roth IRA accounts, and the other is if you have a 401k plan and you're currently actively participating in that 401k, in other words, you're contributing to it, you can also avoid having to take those RMDs until you stop working and stop contributing to that 401k plan. So there's a couple accounts that weren't impacted by it. One quick thing, though, with the Secure Act 2.0 is that up until January of 2023, if you had a Roth 401k plan, that was something that was subject to required minimum distributions. So it really didn't make a whole lot of sense because a Roth IRA account, you don't have to take these required minimum distributions. And even if you did have to take a required minimum distribution from a Roth 401k, there wouldn't be any tax revenue for the IRS. There wouldn't be any taxes that would be due on that. So with the Secure Act 2.0 and 2023, you no longer have to take those required minimum distributions from a Roth 401k. So that's good. They kind of cleaned that up a little bit. Okay, so the second thing we want to talk about are when are these required minimum distributions necessary? So it used to always be for a long, long time that magic age was always 70 and a half. So basically in the year that you reached 70 and a half, you had to start taking these required minimum distributions out of your retirement accounts, those accounts that we just talked about there. I used to always joke around and say, the only people that celebrated half birthdays were the IRS and 5-year-olds. So that 70 and a half always got a little bit confusing, especially considering you can turn 70 70 in one year, but not turn 70 and a half until the following year. So basically, if your birthday falls in the second half of the calendar year, you're going to actually turn 70 and a half in the same year you actually turn 71. So that was always a little bit confusing there. So now, with the Secure Act 1.0, passed a couple of years ago, they changed that from age 70 and a half to age 72. And then now here with the Secure Act 2.0, they changed it again. So now beginning in 2023, that age is 73 for anybody turning 73 right now. And then anybody born in 1960 or later, they push that out a couple more years to age 75. So now you have a couple more years potentially where you don't have to take these required minimum distributions. Something we talk about in a lot of other videos is some tax planning. And just because you don't have to take these required minimum distributions doesn't mean that you shouldn't take them, either just to spend it and do something with that money, or possibly to use that as an opportunity to take advantage of a Roth conversion if you fall within a tax bracket where maybe you still have some room and it still makes sense to do that in a low enough bracket there. But basically the new age is now 73, and if you're born in 1960 or later, that's going to be age 75. So assuming you've reached this required minimum distribution age, how much do you actually have to take out? This is a question that we get asked all the time, and some people have some really false misconceptions about this, thinking that they have to take it all out or they have to start taking it out in big, big chunks. But the reality is that the percentage that you have to take out each year is relatively small. And it is going to be based on a table that the IRS has called the Uniform Life Expectancy Table. And basically there's a divisor that you're going to look up every year based on the age that you're turning that calendar year, and then you're going to divide that number into your December 31st balance from the prior year. So for example, if you're turning 73 and you're required to do a distribution this year, that divisor is going to be 26.5. So if you had $1 million in a retirement account, or in collectively in all of your retirement accounts, that's one thing to kind of note there. So you have to actually add up all of your retirement accounts, and it's going to go into the calculation for this. But basically, it is going to be your December 31st balance from the prior year, and then you're going to divide that 26.5 into, let's say, $1 million, if that's what all your accounts total up to. And that's going to be $37,730, basically, is what's going to be required to take out, or roughly about 3.8% of the balances that you had from the prior year. To kind of put that in perspective, that Uniform Life Expectancy Table is going to mean that that divisor is going to get a little bit smaller every year. Every year you get older, you have a little bit less life expectancy. So at age 85, the divisor drops down from 26.5 down to 16. So if you divide 16 into, let's say, that hypothetical $1 million collective retirement portfolio, that's going to mean that you're going to have to take $62,500 out from those retirement accounts, which works out to be about 6.25%. So, either way, it's not a huge percentage, depending on what your accounts are growing at. You may be growing those accounts still faster than what's required to take out for those RMDs. So 2 quick notes on this. Number one is that you don't have to wait until your required minimum distribution age to take distributions from those retirement accounts. I think most people probably know that, but just to make that clear, you can start taking distributions from your retirement accounts before that required minimum distribution age, number one. And number two, you can take out more than your required minimum distribution. So the IRS never minds if you took out more than what you're required. So if you were supposed to take out $62,000 this year and you wanted to take out $80,000 or $100,000, of course you're going to have to pay taxes on that larger amount, but they don't care that you take out those larger balances. Okay, number 4, what can you do with these required minimum distributions? So assuming you've now hit that age where you have to start taking required minimum distributions from your retirement accounts, what are you going to be able to do with the money? Well, the first thing you should be thinking about is paying taxes on that money. So this is money that typically has not been subject to tax, and so as those distributions come out, that money is going to get added to your taxable income, and it's going to be taxed at your marginal tax rate on your income tax base. So if you're in the 22% tax bracket or 24% or 28%, whatever that is, you're going to be required to pay that tax. So you should be thinking about that as you take these distributions from your retirement accounts. And more than likely, I think the best approach to this is to have some taxes withheld from those actual distributions. So if you think you're in a 24% tax bracket, you should be withholding some portion of that, 20%, maybe 25%, and having that withheld for federal income taxes. If you live in a state that also taxes distributions from retirement accounts and you have a state income tax, you're going to want to have some state taxes withheld as well. One thing you don't want to end up in is a situation where you haven't paid enough money to either the federal government, the IRS, throughout the year, or your state government, and you end up with a penalty. Basically, you didn't give them enough of the tax revenue up front. So you don't want to end up in that situation. So you should be looking at what your taxable income is, what your tax rate is, and having some of that money withheld from the actual distribution. Okay, so once you've accounted for the taxes on your required minimum distribution, what do you do with the rest of the money? Well, my number one suggestion of what to do with that money is just simply spend it. This is money that you've worked hard for. You've saved it throughout your working career, hopefully made some investments that have made some money over time and grown this portfolio. Now you've reached that age, maybe 73, 75 years old, and now you have to start taking these required minimum distributions. Well, you could take that money and reinvest it. We'll talk about that in a second, but really it's money that you've built up and you've saved for your retirement. So if you have things that you want to do, you want to take a vacation, you want to do a house project, buy a new car, gift it to family members. There's a lot of different things you can do, but basically spend the money is one option that you have. And I think quite honestly, for most people, probably the best option. In fact, actually, when we do our comprehensive financial plans, these required minimum distributions actually go into the cash flow projections for our clients. So these required minimum distributions are kind of necessary for them to be able to live the lifestyle that they want throughout retirement. So number one is going to be spending that money. I kind of mentioned it just a second ago there, but you can gift that money to family members. So if you've really gotten to a point where you're doing well enough financially, you're doing all the things you want to do, and there's nothing else that you really want to do with this money, assuming that you've got some family or some beneficiaries that you want this money to go to, rather than maybe waiting until the end of your life to have all of that money pass on to your beneficiaries, you could start gifting that money to your kids or even your grandkids right now so that there could be some benefit to them for the immediate future here. So some things that you can do. So let's say you want to give some money to your kids. If they're not fully maximizing their retirement savings options, some of the money from your required minimum distribution could be gifted to them so that they could make a Roth IRA contribution, or if they're not already fully maximize their 401k plan, you can help them pay down debts if that's something that they have, or student loans, or whatever that may be. So gifting it to family members is definitely something that could be good. Don't overlook the grandkids as well too. That could be kind of a generational skipping thing where you can gift the money to your grandkids, and if they're starting out and trying to pay off student loans, or maybe they have their first jobs and they're able to put money into a Roth IRA account, some of the gifting that you could do from this money coming in from the required minimum distributions could help them to get their own retirement accounts started. So a lot of younger generations, they're not going to have things like pensions and things like that previous generations have. So that's something that you could really help to kind of create that legacy there. You could, of course, reinvest it into some of your own accounts. So you could put that into a non-retirement account. So that's something you could just build up, mutual funds or exchange-traded funds, or buy some stocks in a non-retirement account. There's no restrictions to that. If you qualify for making contributions to a Roth IRA account, you could actually make a Roth IRA contribution to your own Roth IRA if you, in fact, qualify for that. So money can't go directly from that RMD to a Roth. You have to pay taxes on it first, but if you qualify for making that contribution, you can do that. So one last thing you can do with the required minimum distribution money is you can actually make what's called a qualified charitable donation. So you can have money go directly from your traditional retirement account directly to a charity or multiple charities of your choosing. The advantage of this is that money is going to come right off the top of your income. So normally when you make a charitable contribution, it's a line item deduction as far as a itemized deduction. So basically, for a lot of people, as they go into retirement, they're no longer itemizing those deductions. Right now, as it stands, I think the standard deduction is $27,500 for the year. year. So if you don't have any more interest payments because your house is paid off and you don't have a lot of deductions, it may be that if you want to donate $10,000 to charity, you're not even getting above that standard deduction level. So by doing a qualified charitable deduction, you can actually have that $10,000 go right to the charity, and that's going to come right off the top line of income. Now, one interesting thing about this is that we talked about the changes to the required minimum distribution ages, now 73 and 75. For a qualified charitable distribution, they left that at age 70 and a half. So you can actually do that a little bit before those required minimum distributions are going to kick in. So for some people, that really works well, and you can do up to $100,000 per year as a qualified charitable donation. So we have some clients that are actually planning their long-term cash flow around this very thing and actually have IRA accounts set up specifically so they can use that for some of these future charitable donations. So it really is kind of a nice feature there. And again, that money comes right off the top line of income. So number 5, and the last thing we want to talk about here as it relates to these required minimum distributions, is what if you miss a required minimum distribution? Well, prior to 2023, if you missed a required minimum distribution, there would be a 50% excise tax on the amount that you were supposed to take, but you missed. So basically, to give you a quick example here, let's say you were supposed to take $10,000 out for a required minimum distribution, but you forgot to do it, you would actually get hit or assessed with a $5,000 penalty. Now, the good news is that if you kind of caught that reasonably quickly and through maybe some kind of a clerical error, some type of an omission, you just forgot to do it or you missed that payment, you could actually fill out a form, 5329, submit that to the IRS and tell them basically that you made a mistake and you forgot to take your required minimum distribution and you've taken steps or actions to correct the situation. In other words, you've taken now the required minimum distribution that you were supposed to take that you forgot to take. Well, the IRS tended to be very lenient on that. And, as long as it was a reasonable thing and it wasn't happening every year, a lot of times the IRS would just forgive that 50% excise penalty. So a couple things. So one thing with the Secure Act 2.0, they changed that excise tax from a 50% penalty to a 25% penalty. So that's good news generally. But they also put in a provision that says now if you missed one of these required minimum distribution payments and you fill out Form 5329 and they feel it's reasonable, there would be a 10% penalty for that missed RMD payment. So basically they said, okay, we're going to cut that payment down from 50% to 25%, but now we're going to have this extra 10% that even if you send us a letter, this form saying you forgot to take it, we're still probably going to charge you this 10%. So whereas before, I think most people probably didn't end up paying that penalty, now it looks like if you miss it, chances are probably the way we're understanding it is that you're going to get hit with a 10% excise tax penalty on that. So anyway, so there you have it. Those are basically what you need to know regarding required minimum distributions. It really does go into the long-term financial plan. So understanding not only what your tax situation is today, but what is that tax situation out into the future as these required minimum distributions start to kick up. We've talked about it in other videos, but I think a lot of times people have really been led to believe that their tax bracket in the future is going to be lower than what their tax bracket is going to be today. At least that's what I kind of learned when I started putting money into IRAs and 401k plans, back 25, plus years ago, was that, take the tax deduction now and you'll take the money out in retirement when you're in a lower tax bracket. Well, these required minimum distributions for a lot of our financial planning cases end up where people are in a higher tax bracket in the future. Not to mention, we have some current tax rates right now, the Tax Cuts and Jobs Act rates. Those rates are going to expire in just a couple of years. So at the end of 2025, we're going to revert back to what the tax tables were prior to 2018, which is pretty much across the board going to be a higher tax bracket for almost every single income tax category there. Not to mention what could come in the future with all of this debt that the government has been racking up here for decades and decades. I think it's $31 trillion right now, projected to be about $50 trillion in just the next 10 years. So at some point, do they have to start raising income taxes or maybe saying, hey, maybe an easy target are these retirement accounts that haven't had any taxes paid paid on them for decades. Do they start taxing those accounts more potentially? I'm not an expert on what the new tax legislation is going to be. Nobody really knows that for sure. But one thing I do know is that taxes are probably more likely to go up in the future than they are to go down. So understand how these all kind of fit into your overall retirement planning strategy. And remember, if you want to learn a little bit more about what we do at Money Evolution, check out some of the links below. Our comprehensive financial plan called Wealth Vision, our retirement planning course called the Retirement Time Machine. Check all that stuff out. And thanks for watching. Be sure to hit the like and subscribe button there, and I'll see you back in one of our next videos. Thanks.